Hello everyone, if you are new to the channel, welcome. Otherwise, welcome back. In this video, we are going to cover another aspect of the financial world, 5 of the largest well-known frauds ever undertaken. I will try and go over various aspects relating to this topic. However, with all fraud, it's difficult to place exact numbers on the extent of it, but I will try and order them in ascending order of the amount of fraud undertaken. So let's get into it. In at number 5. Theranos. Theranos was a health-orientated startup which was touted to have invented a blood testing technology that would have greatly reduced the time taken to achieve results with a high degree of accuracy, along with only requiring a fraction of the blood required by traditional methods. Theranos was founded by then 19-year-old Elizabeth Holmes in 2003 after she dropped out of Stanford University. Theranos went on to partner with companies such as Safeway and Walgreens and would offer in-store blood tests to their customers. After disappointing results, both deals would be eventually terminated. Theranos would also partner with the Cleveland Clinic in an effort to decrease their lab costs. In turn, the clinic would attempt to validate Theranos's technology. In 2015, the tide turned on Theranos when allegations were made by various sources that Theranos's claims were exaggerated and were not peer-reviewed. In March 2018, the SEC charged Holmes with fraud and with taking more than $700 million from investors while advertising a fake product. On January 3, 2022, she was charged and found guilty of 3 counts of wire fraud on individual investors and 1 count of conspiracy to commit wire fraud on investors. She was also found not guilty on 4 counts of defrauding individual patients. She would receive 11.25 years in prison. In addition, Holmes and her COO, Ramesh Balwani, would be fined $452 million to be paid to their victims. In at number 4, WorldCom. WorldCom, also known as MCI Inc., was a telecommunications company that at one time was the second largest long-distance provider in the United States. Their rise to this position was achieved through the acquisition of other telecommunication companies, which included a merger with MCI Communications in 1997 for around $37 billion. In 1999, WorldCom began a system of overinflating their earnings by documenting expenses as investments. This was an attempt to maintain the share price. The company, however, was becoming increasingly unprofitable. They were still posting profits due to this fraudulent accounting practice. The fraud was uncovered in 2002 by an internal audit which found $3.8 billion of fraudulent entries on their balance sheet. Even before the fraud was revealed, however, WorldCom's stock had lost 94% of its value. Shortly after this, WorldCom filed for Chapter 11 protection. It was later admitted by WorldCom it had overstated its assets by $11 billion. WorldCom's CEO Bernard Ebbers was charged with fraud, conspiracy, and filing false documents with regulators. He was sentenced to 25 years in prison in 2005 and was released early in 2019 due to failing health. He would die in February 2020. In at number 3, FTX. FTX was a former crypto exchange based out of the Bahamas, which at one time was the 3rd largest crypto exchange in the world by volume. FTX was set up by Sam Bankman-Fried. Prior to this, SBF also set up a cryptocurrency trading firm named Alameda Research. FTX was subsequently set up to fund Alameda's activities. SBF promoted Caroline Ellison and Sam Trabucco to co-CEOs of Alameda. However, SBF still owned 90% of the company. In May and June 2022, Alameda suffered a series of losses, and it was leaked that FTX had lent the firm more than half of its customers' funds, which was forbidden by FTX's terms of service. Several leaks detailed that all senior directors were aware of this breach and used software to conceal the misuse of funds. There were also disagreements between Changpeng Zhao, the CEO of Binance, and SBF. This brought to light that Binance held a large portion of FTT tokens, FTX's own crypto token. These disagreements drove down the price of the FTT token. On the 7th of November 2022, Binance announced its intention to sell their large stake of FTT, which caused a run on FTX. As a result of this, $6 billion of withdrawals were made. FTX was not able to meet this demand and immediately suspended further withdrawals. Over the coming days, multiple rescue deals were attempted, but none came to fruition. On November 11, 2022, FTX, along with over 100 affiliate companies, filed for bankruptcy. It was stated that the exchange still owes as much as $8 billion. On the 2nd November 2023, SBF was found guilty of 2 counts of wire fraud and 5 counts of conspiracy. Sentencing will be announced on March 28, 2024. In at number 2, Enron. Enron was an American energy company based in Houston, Texas. During 2001, Enron claimed to have revenues of nearly $138.7 billion. Enron was engaged in a multitude of different business, such as ownership of utility companies, broadband services, along with their primary business of selling natural gas and trading gas contracts. At the beginning of the collapse, Enron was run by Kenneth Lay as chairman, Jeffrey Skilling as president and COO, and Andrew Fastow as CFO. During their tenure, Enron employed an accounting principle called mark-to-market, a practice that based assets on market value which could then be inflated. This created new pressure on executives to hide debt and overinflate existing asset prices. Enron's notoriously complicated financing structures and business model, along with the use of unethical practices, were used to hide this increasing debt. Using these practices, Enron was able to grow its revenue by more than 750% from $13.3 billion to $100.7 billion in only 4 years. During the years 2000 and 2001, questions were being raised on how Enron was able to maintain its stock price as it was trading at over 55 times its earning. It was also stated that investors didn't fully understand how Enron made money. Reviews of their 10K report. The report that each U.S. public company must provide to the SEC each year revealed large amounts of debt being added at an alarming rate. By August 2001, the company's stock price was in decline, Skilling had resigned mid-August, and Greg Wally hired to replace him as COO and Lay as CEO. Mounting concerns over their complex accounts and the sudden exit of Skilling, who has also sold $33 million of Enron stock before leaving, reduced investor confidence. On October 16, 2001, Enron announced their financial statements for 1997 to 2000 would have to be restated as this was required to correct accounting violations. On October 22, 2001, the SEC announced that it was investigating several suspicious deals made by Enron. On October 25, Fastow was removed as CFO in an attempt to restore investor confidence. Several banks had refused to issue loans to Enron while Fastow was CFO. Enron's stock subsequently lost almost half its value within a week. Over the course of November 2001, credit agencies threatened to downgrade Enron's credit rating, and another company, Dynegy, came forward and offered a buyout. On November 28th, Enron's credit rating was reduced to junk status and the buyout deal was scrapped. By the end of the day, the share price was at 61 cents. Enron's stock had been trading around $80 to $90 per share in the late 90s. On December 1, 2001, the Enron board voted to file for Chapter 11 protection. Shareholders lost $70 billion in the 4 years before bankruptcy. $40 to $45 billion was attributed to fraud. They settled out of court for $7.2 billion. 20,000 former Enron employees won $85 million compensation for the loss of their pensions, which were mainly made up of Enron stock, valued at $2 billion. The jury rendered its verdict in May 2006. Kenneth Lay was charged with securities and wire fraud. Jeffrey Skilling was also charged with securities and wire fraud. Kenneth Lay, however, died of a heart attack in July 2006 before sentencing. In October 2006, Kenneth Lay would have had a potential to be sentenced to 45 years in prison. However, his conviction was vacated due to his death. Jeffrey Skilling was sentenced to 24 years and 4 months in prison. He was also ordered to pay $45 million in fines. This was later reduced to 14 years and was released in 2019 after serving 12 years. And in at number 1, Bernie Madoff. Madoff was an American financier who, over the course of about 20 years, by his own revelation, and over 40 years by SEC estimates, built a multi-billion-dollar Ponzi scheme. Madoff started his company, the Bernard L. Madoff Investment Securities LLC, in 1960 with a mix of his own savings and loan from his father-in-law. This firm would focus on trading the pink sheets, and investors were pooled from his wealthy family and their friends. To compete with larger firms, Madoff would use technology to disseminate quotes. This technology would later help develop the Nasdaq exchange. At one point, Madoff was the largest market maker on the Nasdaq. Madoff would also serve 3 terms as the chairman of the exchange over his life. He achieved such a large pool of revenue through a practice called payment for order flow, a legal kickback where brokers would get commission for sending orders to a market maker to execute. All of his tactics only increased his legitimacy within financial circles. Madoff would employ several members of his close family in prominent positions within the company, including his 2 sons, Mark and Andrew. His younger brother Peter would also be hired as a senior MD and chief compliance officer. Over time, his reputation as a wealth manager, his marketing prowess, and his connections to wealthy individuals allowed him to grow the hedge fund at a considerable rate. Wealthy members of the Jewish community trusted Madoff, as he was also Jewish, and only served to cement his position with the community further. During the 70s and 80s, Madoff claimed his hedge fund was using convertible arbitrage to generate profits and promised returns of 18 to 20%. However, retrospective due diligence using historical data have been unable to replicate how Madoff would have been able to achieve these returns. Madoff's operation was not a true Ponzi scheme, as its brokerage operation run by his sons was a legitimate business. Madoff was able to conceal his scheme, as even though he would yield high returns, they were not considered out of the realms of possibility from someone as gifted as Madoff. He would also adjust them according to the market situation. After the 2008 crisis, his fund reported a 5.6% return from his 20% returns on previous years. This at a time when the S&P 500 showed a negative 38% return. Signs of fraudulent schemes often appear when trying to withdraw all money from them. Madoff would pay out those who required it without any issues and in a timely manner, again further solidifying the legitimacy of the scheme. The scheme, however, would start to unravel in late 2008 due to the general market downturn, accelerating due to the financial crisis. Money flowing into the fund was slowing, and banks were no longer loaning money to individuals for investments. Returns, however, for Madoff's funds were still expected, but with no money coming into the fund, Madoff had to resort to taking money from his son's brokerage business to cover the costs. Throughout the fraud, Madoff was simply depositing clients' money into a business account at Chase Manhattan Bank. He would use this to pay them when they requested it. When this account began to run low on funds, Madoff requested money from his long-term contacts to cover the requests. At the beginning of December 2008, Madoff knew the scheme would soon be at an end and informed Frank DePasquale, who oversaw the Ponzi scheme for over 30 years, that he was done. Madoff informed DePasquale to cash out the remaining $234 million in the Chase account to relatives and favored investors. On December 10th, Madoff suggested to his sons that the firm should pay out over $170 million in bonuses 2 months early from the assets remaining. His sons questioned how they could pay bonuses when they could not pay investors, to which Madoff admitted to them the whole of the asset management arm of the firm was a Ponzi scheme. His sons, upon hearing this, would take legal representation and subsequently inform the SEC. Madoff was arrested the following morning. Multiple individuals and firms were investigated as part of the Ponzi scheme, and lengthy prison sentences were handed out along with substantial fines. Madoff's sons, Mark and Andrew, while working in the legitimate arm of the business, did not escape the fallout from the scheme. Their assets were frozen in March 2009. Civil suits were also filed against them. Mark would commit suicide on the 2nd anniversary of his father's arrest, and Andrew would die from cancer on September 3, 2014, at the age of 48. In June 2017, the suits were settled against their estates for more than $23 million. Frank DePasquale, who ran the Ponzi's day-to-day operations, was found guilty of 10 counts of fraud, however, died while awaiting sentencing. Peter Madoff pleaded guilty in federal court to a variety of charges and agreed to a 10-year prison term. He was released from prison on August 13, 2020. Madoff himself would be found guilty multiple federal felonies, including securities fraud, wire fraud, mail fraud, money laundering, making false statements, perjury, theft from an employee benefit plan, and making false filings with the SEC. It was estimated that Madoff was responsible for at least $13 billion in fraud. A commonly quoted figure is around $65 billion. It was such a huge amount that federal guidelines for fraud sentencing only goes up to $400 million. Madoff was sentenced to 150 years in prison and ordered to pay $170 billion in restitution to his victims. Madoff would die of natural causes in prison in 2021 at the age of 82. That is all for this video. Please re-watch if anything is unclear. Comment if you want more information, and I will make further videos. If you want more information on why I'm making these videos, please check this video here. Please subscribe, donate, like, and comment. As always, look after yourself and your money, and I will see you in the next video.